You kept asking for it. So here it is. Okay, the investment strategist tier list. Now, this is not financial advice, okay? It's common sense backed up by data. And fair warning here, most of you are not going to like where your favorite strategy lands. But that's the point, okay? Some ways of investing are wealth traps. Others are proven paths to millions, and only a rare few are how billionaires scale money at a global scale. So, let's break it down from the absolute worst to the very best ways to invest your hard-earned cash. Welcome to Alex. All right, we're starting off at FF tier, speculation investing, also known as the land of TikTok finance brothers. So, on the surface, this looks like investing, right? You've got charts, brokers, fancy words like options and margins, but you could think about it like trying to get rich by betting on coin flips. Speculation attracts beginners who want quick wins and don't want to wait years of compounding to work. It looks smart with all of those charts and brokers, but underneath it is basically gambling. People fall into this tier because they want money fast, but fast money almost always leaves even faster. So, here's the simplest way to see it. Okay, imagine you've got $1,000. A broker says, "Don't worry, I'll lend you 20 times that amount." You can place bets as if you had 20,000. Well, if the asset you bet on goes up 1%, your $20,000 position grows by $200. That's a 20% profit on your $1,000 instantly. Feels incredible. But if it goes down 1%, you lose $200. That's 20% gone. If it falls 5%, your entire $1,000 is wiped out. Zero. That's how CFDs or contract for difference work. You never actually own the stock or the currency. You're just guessing whether the price will go up or down. It feels like you're investing, but it's really betting with borrowed money. The regulators know how bad it is. Okay, in Europe, ESMA forces CFD brokers to post a warning on their websites. 74% to 89% of retail investor accounts lose money trading CFDs. Academic studies back this up. Okay, research by Barber, Lee, Liu, and Odin showed that over 80% of day traders lose money, and only a tiny group make profits consistently. And even outside of CFDs, speculation hides in products like high-fee manual funds. The bottom line is speculation investing is designed for newbies who think they might be one of the lucky ones. It exploits the naive of people desperate for quick wins, and that is why it sits firmly in F tier. Now on D tier to D tier, momentum investing. So D tier is what happens when people confuse hype for strategy. Momentum chasing means buying whatever is hot, whether it's meme stocks, a sector bubble, or flipping houses in overheated markets. The logic is simple. It went up yesterday, so it'll keep going up tomorrow. Momentum chasing attracts people who don't want to be left out. It's fully fueled by FOMO. You see a coworker double their money on a stock, so you buy in. You watch houses selling for ridiculous markups, so you borrow to flip one yourself. It feels smart because everyone around you is making money. But this logic is broken, okay? It's the same as saying if a baby doubled in weight in their first year, they'll weigh 7 tons by the time they finish high school. Growth curves don't work like that. What shoots up fast eventually slows, stalls, or reverses. Take real estate, okay? During hot markets, flippers make quick fortunes. But when the market cooled off in 2025, margins collapsed. Atom data shows that flipping profits fell to a 17-year low, averaging under 25% before expenses. So, by the time you pay for renovations, taxes, and realtor fees, many flippers are barely breaking even. Or even worse, they're losing money. And stocks tell the same story. In every bubble, dots in the early 2000s, meme stocks in 2021, AI darlings today, the early players win big. But most people only hear about it once the headlines hit. That's usually the top. By the time they buy in, the insiders are already cashing out. That's why momentum chasing sits in D tier. I mean, at least here, you own something, unlike F tier, where you own nothing at all, but you're not investing based on fundamentals. You're just betting that line will keep climbing forever. Now, before we move on to the strategies most likely to build actual wealth, I want to give you a little heads up that inside the Alex app, we've got an expert collection written and presented by private equity insider Aram Tagabi. So, he specializes in A and S tier investing, which we'll get to in a moment. And even if you're not ready to make those kinds of investment moves yet, it's wise to be thinking ahead. Okay, Aaron will walk you through buying your first business even if you don't have capital, negotiating seats at tables that you don't yet belong to, plus insider information that you need to avoid risk while still making a lot of money in the process. And as a special YouTube offer, if you click the link in the description, you'll score an exclusive 30% off the annual app membership, daily coaching sessions, dozens of expert-led courses, and real-time tracking tools to help you get closer to your goals. It's a no-brainer. Okay, so I'll see you on the inside. But in the meantime, let's get back to these investment strategies, shall we? So, CC capital preservation. So, it's not capital investing because, well, you're only investing in theory, but this is where you stop doing dumb all the time. No more blowing up accounts on day trade, no more chasing bubbles, no more doubling down on leverage. Capital preservation is about safety and liquidity. These are savings accounts, CDS, and dipping into index funds without scale. Nobody gets stupid rich here, but for the first time, you're not losing anything. And that puts you ahead of millions of people who are stuck in F&D tier. But here's the trade-off, okay? Savings don't beat inflation. In October 2025, the average savings account in the U.S. paid just 0.4% interest. Meanwhile, inflation was around 2.9% a year. That means parking. 10 grand for a year earns you $40 while prices rise by nearly $300. Your balance looks the same, but your buying power shrinks. So, why do people still keep money here? Well, there are essentially 3 reasons, and they are pretty solid. First of all, liquidity. You can access cash instantly in an emergency. Try selling real estate overnight. Not happening. Then there's safety. In the U.S., savings accounts are FDICs insured up to $250,000. So even if the bank fails, you are covered. And it's habit building. For beginners, it's like training wheels. Setting money aside in an actual account designated for it creates a sort of mental separation from them. It prepares you to stop being so emotional about your money. From a wealth perspective, Kaya is not exactly success, but it's survival with stability. You won't get rich here, but you prove that you can hold on to money without destroying it. That foundation is what lets you move up to real wealth building strategies. B tier, then there's B tier. That's long-term compounding. So, here's something you don't want to hear. Okay? Everyone agrees, from economics professors all the way up to Warren Buffett, that long-term compounding is the single best investment strategy for 99.9% of people. Anyone telling you otherwise is just trying to sell you something, okay? Just park your money in a low-cost index fund, forget about it, and go do something useful with your life. Stop pretending that you're the next trading genius. Stop chasing hot tips. Just buy the market, hold it, and let time do the work. The S&P 500 has returned roughly 10% per year on average since 1926. After inflation, that's still about 7% real growth. Compounded over decades, $10,000 becomes $80,000 in 30 years, $150,000 in 40. You don't have to outsmart anyone, okay? You don't have to watch charts at 3 a.m. You just sit still while time compounds your money. And research proves that it's better than what most professionals manage. The SPA report shows a majority of actively managed funds underperform their benchmarks over 10 to 15 years. Beating the market. Look, it's a fantasy for almost everyone. Owning the market, that is enough. So, why don't most people do it? Well, honestly, because it's boring. It's low risk, steady reward, and it takes a long time. There's nothing to brag about at a dinner party when your money is slowly compounding in an index fund. Everyone thinks they're Warren Buffett Jr. chasing stock picks or speculative bets, but nobody wants to admit that the boring strategy is the winning one. The only reason this strategy isn't S tier is because rich people still exist. Once you control massive amounts of capital, you unlock something different. Things like private equity, venture capital, and tax plays that simply aren't available to regular investors. But for everybody else, this right here is the most likely path to wealth. And now at tier, we're moving on to the really good stuff. Okay, a tier is active investing. So active investing is like long-term compounding, but with a little bit of a personal touch. If B tier is putting money into an index fund and forgetting about it, a tier is where you still believe in compounding, but you want to shape the ride. So instead of blindly owning the whole market, you start making changes to your portfolio. Maybe you want more diversification than just the S&P 500. Maybe you prefer certain industries. Maybe you want to avoid others. So active investing is where you buy the index but then start customizing. So at the top expert level, this becomes value investing. That's where you look for companies that are undervalued today but would be worth far more in the future. Now, obviously, you need to understand why they're undervalued. Sometimes a company is cheap for a reason: poor management, shrinking industry, a weak product. Other times, it's overlooked despite strong fundamentals. The skill lies in knowing the difference. Warren Buffett built an empire by spotting those kinds of mismatches, buying when nobody cared, and waiting decades for the market to catch up. The truth is most people who try active investing don't outperform simple index compounding. Morningstar's data shows a majority of active funds underperform massive benchmarks over 10 to 15 years. But the ones who do succeed can beat the market and accelerate wealth faster than B tier alone. That's why a tier sits above long-term compounding, but below billionaire strategies. For most, it's just compounding with a little personal flavor. For the few with skill and patience, this is a path to outperform. S tier, and finally, we've got S tier, ownership and capital gains. So, this tier runs on scale and access. With tens or hundreds of millions of dollars to deploy, billionaires enter deals regular investors simply can't touch. Private equity lets them buy entire businesses, restructure them, and capture the upside. Venture capital gives them early slices of the next Google or Tesla before it ever goes public. And when those bets hit, the returns are exponential. Capital gains are the engine here. Okay, the U.S. saw $4 trillion in capital gains in 2021 alone, more than all wages combined. But the ultra-rich, they don't sell. They borrow against their appreciated assets instead, living tax-free while their wealth compounds untouched. This is the buy, borrow, die strategy, the invisible escalator that keeps billionaires rising while everyone else is grinding. From a wealth perspective, S tier is out of reach for 99% of people. And that's kind of the point. All right, Alexa,